Meet Jason. He's 35 years old, earns about $75,000 a year, and has spent the last decade doing everything personal finance experts tell you to do. He contributes to retirement accounts, buys index funds, avoids credit card debt, and every month, without fail, he invests a portion of his paycheck. One evening, he opens his investment account and sees a number that changes everything. $502,143. For most people, that looks like a random milestone, halfway to $1 million. Nothing special. But what Jason doesn't realize is that he has just crossed one of the most important financial thresholds of his entire life. Because from this point forward, his money starts working harder than he does. And once that happens, wealth building becomes a completely different game. My name is Alex, and today I want to show you why $500,000 invested is where the rules begin to change. Not because you're suddenly rich, but because this is where compounding finally becomes impossible to ignore. Most people think becoming wealthy is about making more money, getting a promotion, starting a side hustle, landing a higher paying job. And in the beginning, that's mostly true. When your portfolio is small, almost all of your progress comes from your contributions. You're the engine. Your savings rate determines everything, but eventually something strange happens. Your investments begin generating meaningful amounts of money on their own. Let's look at the math. A $500,000 portfolio earning 8% annually generates roughly $40,000 per year. Think about that. $40,000 without working overtime, without asking for a raise, without starting a business, just from owning assets. For many households, that's close to an entire year's salary. And that's why $500,000 matters. Not because it's enough to retire, because it marks the moment where your investments become a serious financial force. Here's the part most people underestimate. The journey from $0 to $500,000 is much harder than the journey from $500,000 to $1 million. That sounds ridiculous, but it's true. Imagine you're pushing a giant boulder uphill. At first, it barely moves. Every dollar comes directly from your effort. You sacrifice. You budget. You save. Progress feels painfully slow. Then gradually the slope begins to flatten. The boulder gains momentum. And eventually it starts helping itself. But the biggest change isn't mathematical. It's psychological. When Jason had $20,000 invested, every market drop felt terrifying. A 10% decline meant losing $2,000. Painful, but manageable. At $500,000, a 10% drop means watching $50,000 disappear on a screen. And surprisingly, this is where investors reveal who they really are. Because reaching $500,000 isn't the challenge. Keeping it is. The investors who succeed learn an important lesson. The market rewards patience more than intelligence. Most wealth isn't built through brilliant decisions. It's built by avoiding terrible ones. Not panic selling. Not chasing trends. Not believing every financial guru who claims they've discovered the next big thing. The hidden benefit nobody talks about. There's another benefit to reaching $500,000 invested that almost nobody talks about. It changes the way you think about time. When most people think about money, they're really thinking about hours. How many hours do I need to work to buy this? How many hours of overtime will cover that expense? How many years until I can finally slow down? Everything gets measured in labor. But once your investments reach a certain size, you start thinking differently. Because your portfolio begins generating results while you're sleeping. Imagine waking up one morning and seeing that your investments increased by $1,000 in a single day. You didn't clock in. You didn't attend meetings. You didn't answer emails. The money showed up because your assets were productive. Of course, the opposite can happen too. The market can drop by $1,000 in a day just as easily. But over long periods of time, productive assets tend to move upward. And that's when something interesting happens. You stop viewing money as something you earn. You start viewing it as something you own. That's a completely different mindset. People building their first few $1,000s are focused on income. People with larger portfolios become focused on ownership. Ownership of businesses. Ownership of stocks. Ownership of assets that create value over time. That's why wealthy people often seem obsessed with investing. They're not necessarily smarter. Unfortunately, this is also where many people sabotage themselves. The moment their account reaches a large number, they start upgrading everything. Bigger house, more expensive car, luxury vacations. Lifestyle inflation quietly begins eating away at future wealth. And here's the dangerous part. Every permanent increase in spending pushes financial freedom further away. If your lifestyle costs $50,000 per year, financial independence might require around $1.25 million invested. Increase spending to $80,000 annually, and suddenly you need closer to $2 million. Same person, same income, different finish line. That's why so many high earners stay trapped. Their spending rises as quickly as their wealth. There's another mistake people make after reaching this milestone. They get bored. Seriously. After years of investing in boring index funds, some investors start looking for excitement. Options trading, crypto speculation, hot stock picks, complex strategies. They convince themselves they're being sophisticated, but often they're just gambling with larger numbers. The irony is that boring is usually what works. The same strategy that got you to $500,000 is often the strategy that gets you $1 million and beyond. Consistency beats excitement. Almost every time. Now let's go back to Jason. Imagine he reaches $500,000 at age 40. If he continues investing, great. But here's what's fascinating. Even if he stopped contributing completely and earned an average 8% annual return, that portfolio could grow to more than $2 million over the next couple of decades. His money now has momentum. Options begin to appear. He can take a lower stress job, work fewer hours, start a business, pursue projects that aren't immediately profitable. Not because he's wealthy, because he has leverage. And leverage creates freedom. That's the real value of $500,000, not the number itself. The choices it creates. Now, before you start thinking $500,000 means you've made it, let's add some reality. A $500,000 portfolio is powerful, but it isn't financial independence for most people. Using the popular 4% rule, that portfolio could support roughly $20,000 per year in withdrawals. Helpful? Absolutely. Enough for most people to retire comfortably? Not even close. So this milestone isn't the finish line. It's the transition point. The moment where building wealth becomes less about effort and more about patience. The hardest part was never making money. The hardest part was staying in the game long enough for your money to start making money on its own. And once that happens, everything changes.